I am an Opendoor investor, and I have to admit the last year or so has not been easy for me as the stock lost more than 90% of its value. I've been dollar cost averaging on the way down, but Opendoor is still hovering near its all-time lows of $1 a share, which to be honest got me quite worried. But Opendoor just posted blowout Q1 earnings results, beating both earnings per share and revenue estimates. As a result, the stock surged more than 30% the following day. So in today's video, we'll be taking a look at Opendoor's Q1 earnings results, including its growth, profitability, and balance sheet. We'll take a look at its valuation as well as its risks, and if you stick till the end, you'll find out what I'll be doing with Opendoor stock. My name is Riero, and this channel is all about finding the companies of tomorrow, those high growth companies, disruptors, multi-baggers that'll generate the most investment returns. If that is something that you like to hear, don't forget to subscribe to my channel so you won't miss future videos and investment ideas. With that said, let's take a look at Opendoor stock. So before we jump into Opendoor's Q1 earnings results, let's take a look at what the company does. So Opendoor is the leading e-commerce platform for residential real estate transactions, and what the company does is that they are reinventing how people buy and sell homes, which is typically the largest transaction a person makes in his or her life, and probably the most stressful one as well. So this chart shows the traditional way of selling homes. So 89% of the time an agent is involved, and after finding an agent, the seller needs to get the home sale ready by doing repairs. They need to host open houses, they need to conduct inspections and do negotiations and so on. So the traditional way could take more than 3 months from start to finish, which by the way has a 20% chance of falling through between signing and closing, forcing the seller to start the whole process all over again. On top of that, home sellers need to find a new home, which meant having to deal with more headaches such as getting a new mortgage, gathering cash for down payments, and negotiating with homeowners and their agents as well. As you can imagine, the entire home selling and buying process is highly complex, uncertain, time-consuming, costly, but most importantly, mentally exhausting. And that's where Opendoor comes in. In a nutshell, Opendoor is an all-in-one platform that gives consumers the power to buy and sell homes at the tap of a button. So the company offers two core product offerings. One is the first party product or iBuying, and secondly is the third party product or marketplace. So through the first party product or iBuying product, people can sell their homes directly to Opendoor, and Opendoor then resells the home to a home buyer. So the process is rather simple. First, the customer can request an offer by entering his or her address at Opendoor's website or app. The customer will then receive an initial offer, which are auto-generated using Opendoor's pricing algorithm. If the customer is satisfied with the offer, Opendoor will then conduct a virtual interior and exterior home assessment to verify the condition of the home and finalize the offer. And finally, the customer can choose his or her preferred closing date. So Opendoor charges the customer a service fee of 5% compared to the traditional broker fee of 5 to 6%. I think this is incredible value considering that selling to Opendoor means that homeowners can avoid the trouble of open houses, home repairs, negotiations, and so on. Not to mention, selling to Opendoor is entirely digital. And similarly, customers can buy homes listed on the Opendoor platform, which has an equally simple step-by-step process that customers can follow. So that's iBuying. On the other side, Opendoor recently launched its 3P marketplace product called Exclusives, which connects home sellers with institutional or retail buyers, facilitating the transaction without Opendoor taking ownership of the home. In other words, the 3P model is a much more capital-light business model than the 1P model, which requires significant capital since Opendoor is purchasing homes directly from consumers. So through Opendoor Exclusives, sellers can request an offer from Opendoor's network of buyers while also receiving an Opendoor cash offer. On the other hand, buyers can buy homes through Exclusives, which offers off-market homes at a discount for 14 days before they are listed on the public market. So whether through its 1P or 3P products, Opendoor's mission is to power life's progress one move at a time. Ultimately, the company offers an end-to-end platform for people to buy and sell homes, which is simpler, more certain, and faster than the traditional process of buying and selling homes. Now that we've talked about what Opendoor does as a company, let's dig into Opendoor's financials. As you can see, revenue growth went through the roof in 2021, where growth peaked at 1,400% in Q4 of 2021. This massive growth figure is due to much lower inventory levels in 2020 as the company paused home purchases in the wake of the pandemic. Since then, revenue decelerated significantly as the housing market cools down and went negative in the last 2 quarters as high inflation caused the Fed to hike interest rates at a record pace, causing mortgage rates to spike as well. As a result, the decline in housing affordability caused many home buyers to stay on the sidelines, thus decreasing overall transaction volume. Nonetheless, 2022 was still an up year for Opendoor, with revenue growing 94% year over year to $15.6 billion. This was primarily due to a higher number of homes sold as well as higher revenue per home. Market expansion also contributed to growth as Opendoor expanded from 44 markets to 53 markets by the end of 2022. On the other hand, Q1 revenue was $3.1 billion, which is down 39% year over year, and this is due to lower sales volume as well as lower price per home. Despite the slowdown, Q1 revenue exceeded the high end of Opendoor's revenue guidance by 18% as the company enjoyed market clearance rates of 3% in Q1 compared to market clearance rates of 1% to 2% typically observed in the first quarter of each year in the past decade. As mentioned, revenue growth was due to higher sales volumes, but in order to sell more homes, Opendoor needs to buy more homes first, and that is what the company has done in 2021 and early 2022. As you can see here, Opendoor has been buying lots of homes in 2021 and early 2022. So in 2022, Opendoor purchased 35,000 homes, which is down 5% year over year. On the other hand, Opendoor sold 39,000 plus homes in 2022, which is up 80% year over year. However, since the Fed began raising interest rates in Q2 of 2022, Opendoor has slowed down the pace of home acquisitions as home buying demand took a hit. As such, the company has less active listings and therefore sold less homes, which consequently translates to lower revenue. As you can see, homes purchased in the last 3 quarters were down significantly compared to the previous year. In Q1, Opendoor only purchased 1,700 homes, which is down 81% year over year. And the reason for this drop is due to sellers staying on the sidelines, lower marketing spend, as well as higher spreads embedded in Opendoor's offers, which resulted in lower conversions. On the other side, it is great to see that Opendoor is still able to sell homes in this kind of market environment, even though it's still down from the previous year. So in Q1, Opendoor sold 8,200 homes, which is down 35% year over year. The revenue growth that we've seen in 2021 and 2022 was also driven by higher revenue per home sold. So in 2022, revenue per home sold was $397,000, which is up 8% year over year, and this is due to inventory mix, buyback expansion, as well as home price appreciation. In Q1, however, the housing correction put some pressure on Opendoor's top line as the price per home sold dropped 7% year over year to $377,000 per home. With that said, I expect revenue per home sold to stabilize in the next few quarters and eventually return to incremental growth as the Fed begins cutting interest rates in late this year or early next year. Despite the challenging macro environment that we've seen, it is important to note that the long-term trajectory of residential properties has always been up and to the right. And yes, we're gonna see some down years here and there, but the long-term trend has always been positive, and that will be a long-term tailwind for Opendoor. I think the growth potential for Opendoor is absolutely massive as well. Residential real estate is the largest undisrupted industry in the United States, with more than 6 million homes sold annually, representing over $2.3 trillion in transactions in 2021 and $1.9 trillion in 2022. Additionally, 66% of Americans are homeowners, and housing is the single largest consumer expenditure ahead of transportation, food, insurance, and healthcare. And while residential real estate is a massive market, it is still largely offline. As you can see here, iBuyers only make up 1% of total transactions in 2022, and the drop from 2021 is probably due to Zillow exiting the iBuying business. Here we can see that Zillow accounts for 35% of iBuyer market share in 2021. And after leaving the iBuying business, Opendoor now makes up almost 80% of the iBuyer market share, which is by definition a virtual monopoly, and this should give Opendoor a substantial competitive advantage over competitors like Offerpad and Redfin. That aside, iBuyer market share is growing rapidly, and with 99% of residential real estate transactions still happening offline, there lies a massive opportunity for Opendoor to gain market share over the next decade or so. With that said, Opendoor seems to be growing at a massive clip, and the slowdown that we've seen in 2022 and probably this year is due to cyclical reasons. I mean, there's going to be a period of expansion and recession in the housing industry, and it seems that we're going to a housing recession currently. That, of course, is going to be a headwind for Opendoor, which is why I think the stock is down so much. But I also see it as an incredible opportunity for Opendoor. I think a volatile housing market could actually help Opendoor gain market share as people want transparency, certainty, and speed. The Opendoor value proposition is amazing, which is why I think the company has a long growth runway ahead, regardless of whether we're in a recession or not. Now let's take a look at the profitability of the company. While business growth has been great, profitability remains a concern. In 2022, gross profit was 667 million, which is a 4.3% gross margin and a 7% adjusted gross margin. And in Q1, gross profit was 170 million, which is a 5.4% gross margin and a negative 3.3% adjusted gross margin. So gross margins are in a downtrend, and this is due to management's decision to prioritize risk management and resale clearance of old inventory as a result of the housing market decline. The weakness in the housing market also leads to negative inventory valuation adjustments, which is embedded in gross margins. So in Opendoor's Q4 shareholder letter, management explained why margins took a beating. So there was a once in a 40 macro shift that started in the middle of the second quarter last year, with the Fed raising target rates by 300 basis points in less than 5 months, catalyzing the fastest shift in housing conditions in 4 decades. And management mentioned that 1 month home price appreciation moved from positive 300 basis points in May to negative 100 basis points by mid-July. And this resulted in annualized existing home transactions declining by nearly 35% year over year to 4 million in December. So because of this sudden change in the housing market, management responded by managing risk and inventory health. On the resale side, Opendoor reduced list prices, but they did not do this quickly or aggressively enough, which led to a slowdown in its clearance rate. On the acquisition side, the company materially widened its acquisition spreads and cut back on marketing spending. So all these factors contributed to a large book of loss making in inventory, which is embedded in gross profits. With that said, I've also included adjusted gross margin numbers, which aligns the timing of inventory valuation adjustments recorded under GAAP to the period in which the home is sold. So it is better to look at adjusted gross profit if you want to know how much profit or loss the company is making for the homes that are sold in the quarter, regardless of when they are purchased. So for example, GAAP gross profit is positive in Q1 and Q4 when in fact the company made losses on the houses sold, as seen by the negative adjusted gross margins here. This is because most of the inventory valuation adjustments were recorded in Q3 of 2022 during the large housing correction, which is why we saw a very negative gross profit here in Q3. Nevertheless, adjusted gross profits are still negative, which shows that homes are still being sold at a loss. Moving on, contribution profit, which counts for direct selling costs and holding costs, was 525 million in 2022, which is a 3.4% contribution margin. This is a decrease from 2021's 6.5% contribution margin, and this also fell short of the company's annual contribution margin target of 4 to 6%. In Q1, contribution margins dropped to negative 7.7%, and this is due to lower adjusted gross margins, higher direct selling costs, and higher holding costs, as well as the company selling old inventory at a loss. So management has been laser focused in selling its old inventory, more specifically the homes that Opendoor acquired at peak prices between March and June of last year before the housing market reset. So the homes acquired back in March and June of last year are called the Q2 cohort, and back in Q4, management expect to have sold or be in contract on over 85% of the cohort by the end of Q1. And once the old book is behind them, they expect the return to positive unit margins by the second half of 2023. However, in Q1, homes were selling faster and better than expected, as seen by the higher market clearance rate of 3%, which is higher than the typical market clearance rate of 1 to 2%. As such, 92% of the homes in the Q2 cohort were sold or in contract as of the end of the quarter, which is higher than the prior expectation of 85%. With that said, Q2 cohort and older, which has lower margins, represented 75% of total resale mix in Q1, which puts a lot of pressure on the company's overall margin profile. However, as shown here, Opendoor's new book of inventory showed strong margin performance with gross margins of 12.2% and contribution margins of 8.5% in the first quarter. But since they only make up 25% of total sales, the profits made from the new book was not able to offset the losses made from the old book. But moving forward, we should see margins improving as Opendoor unloads the remaining 8% of its Q2 cohort and the higher margin new book of inventory make a greater portion of total sales. Moving down the income statement, net loss was $1.4 billion in 2022, which is an 8.7% net margin or a negative 3.7% adjusted net margin. This was driven by contribution margin losses from the Q2 cohort as well as lower revenue, which impacted Opendoor's ability to cover its variable and fixed cost structure. Interest expense also increased 169% year over year due to a higher debt balance and higher interest rates. Q1 net loss was $101 million, which is a negative 3% net margin and also a negative 13% adjusted net margin. And as a reminder, adjusted net loss aligns the timing of inventory valuation adjustments recorded under GAAP to the period in which the related revenue is recorded. And as you can see, adjusted net margin, which is the gray line right here, is at an inflection point as it improves quarter over quarter from negative 16% to negative 13%. So moving forward, I see margins continue to improve as Opendoor disposes its lower margin old book and continues selling more of its higher margin new book. In addition, Opendoor has also been taking proactive measures to reduce spending, and here we can see that adjusted operating expenses has been on a downtrend since Q2 of 2022, dropping from $204 million to just $100 million in Q1. The company also announced another round of layoffs in April, which reduces its workforce by 22% or 560 employees. And with the layoffs, management expects another $50 million reduction in annualized expenses, so this should improve margins moving forward. All in all, Opendoor has really awful profitability metrics, but it seems to be improving as the company looked past its old inventory. The problem with Opendoor's business model is that they need to scale in order to cover their variable and fixed cost structure. And that way, the company can turn profitable and maintain that profitability through economies of scale and operating leverage. However, in this kind of market environment, I don't think we'll be seeing Opendoor profitable anytime soon. Maybe in late 2024 or in early 2025 when the company returns to growth mode. That said, I think the worst is already behind us and I see the potential for Opendoor to improve margins as the housing market stabilizes, as management cut unnecessary spending, and as the company rolls out its 3P marketplace product. This is part 1 of a 2-part video, and if you're interested in watching part 2 of my Opendoor stock analysis where I talk more about valuation and risks, you can click this video right here, or you can find the link to the second part in the description below. With that said, thank you so much for watching this video, and don't forget to hit the like button and subscribe for more investment content.